Very frequently, options traders will underestimate the effect of options volatility on their positions. This is particularly true when your trading position is what they call negative vega, meaning that the P&L of the trade will at least temporarily respond badly to an increase in options volatility. It's important at these times, though, to keep your head and stick to your plan, and most of the time it will work out well for you as long as you don't panic. So let's take a look at an example. A very common options trade is what's called an iron condor. And an iron condor is composed of a call credit spread, what's called a call credit spread, that's out of the money, and a put credit spread that's also out of the money. So let's take a look at an example we've set up for you today. This is a trade in the Russell 2000 index, which at the time of this example, which is earlier this year, 2018, it's running at about 1583 is the level of price of the Russell 2000 index. So in this particular example, we're going to sell the 1720 Russell 2000 index May monthly call, and we're also going to sell the Russell 2000 1460 put. We're going to buy wings, what are called wings, which is really protection, 20 points further out of the money in either direction. So on the call side it would be the 1740, on the put side it would be the 1440. So those would be our wings. So in this particular trade, the trader is going to get a $1 credit for each upside call side option, and a $2 credit for each put side credit spread. So that as in this particular index, the Russell 2000 index, everything's multiplied by 100. If you do the math, you'll end up with a credit on a 10 lot of this nature of 3,000 bucks. So in this case, there was a $3,000 credit initially earned in the trade, initially brought into the account of the trader, but he's taking some risk by receiving that $3,000. So let's say we have a very simple, I would call it almost a simplistic protocol for this iron condor trade, and that would be if the loss number on the trade at any point during the trade gets more than twice the size of the original credit brought in, then you close the trade, you exit, that's your stop. If, on the other hand, either of the credit spreads shrinks down from $1 or $2, as the case may be, down to a dime, meaning you've made a lot of profit on that side, then you close that side, ending the risk. So this would be a sort of a common approach to trading iron condors. If you do get a profit, then the trade will, you'll receive almost all of the credit that you originally received as your profit. On the other hand, you could take a loss, which in this case would be a $6,000 loss versus approximately a little bit less than a $3,000 gain. So basically, if the market stays between 720 and between 1720 and 1460, you will earn the entire profit because the market will, because all of the options in your trade will have expired worthless, in which case then you just go home, you take your profit, and no one can make any claims on the options that you've put forth into the market. So let's take a look at the trade according to the model. The model that we're using here is estimating that the market, if it reaches 1483, which would be quite a drop from the current level, exactly 100 points, if it drops to 1483, then the loss on the trade would be $2,400. So that's well off your stop, which is $6,000. Now let's take a look at what happens, though, because the market did in fact drop to 1483 19 days later. And when that happened, the loss was actually $3,400, not $2,400. Now, this is a paper loss. You have not realized this loss yet, but that is your current P&L. Well, why did that happen? I thought the model said it was going to be a $2,400 loss. Why is it a $3,400 loss? And the answer is because of something called options volatility. And in the case of this strategy, it reacts adversely to increases or spikes in options volatility, and therefore what's happened here is we have, as you can see on this chart, when we started the trade, options volatility was low. When the market sold down to 1483, that caused, as it normally does, a large increase in options volatility up above that 20% level. Whereas we started originally in about the 15% level, as you can see from this graph. So therefore, there's been a big bump, and the options volatility caused the trade to actually perform worse than the model would have expected, and that's because of this spike that has occurred in options volatility. Now, but let's think about it a little bit. What is the size of this loss? The size of the loss at the moment is $3,400. That's way below our stop of $6,000, even though it's $1,000 worse than we expected. This is the point which separates the men from the boys in the options trading world, because if at this point you panic and say, something's wrong here, my model said $2,400 loss at this point, I'm experiencing a $3,400 loss, I better get out of here before this gets worse, and you close the trade. Well, usually you will regret taking that action. Even though your model didn't quite predict accurately what was going to happen, you had plenty of room for your stop. So let's take a look at what actually did happen. First of all, 29 days into the trade, we're able to remove the call side. Remember, we were talking about removing the call side when it shrinks down to a dime. Well, if you take a look at this table, you'll see, this options chain, you will see that in fact the market has shrunk the call side credit spread down to a dime. So we're going to remove that, which, by the way, removes all upside risk. So this is what the trade looks like right before we take off the call credit spread. Then, 9 days before expiration, we're in the trade about 56 days at this point, we're able to take off the put side for a dime, and that is because the market had bounced enough that we basically scalped the put side and closed the trade for about a $2,800 profit, close to our $3,000, but we had to pay a little bit to take the risk off the table for the call side originally and the put side secondarily. High options volatility can distort a trade P&L greatly, as you saw in this example, but you can't panic just because your model did not exactly predict what was going to happen. Very frequently, as you saw in this example, these periods of high volatility, which is normally accompanied by a sell-off, subside. You get a bounce, and once you get that bounce, you'd be amazed at how much profit flows into the trade from that reduction in options volatility that comes along with the bounce. So the key is to stick to your game plan and ignore the noise of options volatility as long as you have not hit your stop. You must never violate your stop. But if you do, in fact, come close to your stop or have a P&L situation which is worse than you expected, you should stick to your guns, stick to your plan, and the trade will often work out fine. Think about it. In this case, had you panicked out of the trade, you would have had a $3,400 loss, whereas by staying in the trade, you had a gain of $2,800. That's a swing in outcomes of $6,200, which on your annual returns of your options trading is going to be a very significant percentage. And all you had to do was follow your game plan and not get worried about the noise and the distraction or the fact that your model did not precisely predict what was going to happen. Don't worry about that. Stops have to be followed under all circumstances, but if they haven't been hit and $3,400 is a long way from $6,000, you've got to let it go and have patience and courage and allow the trade to play out. These trades are designed to win most of the time, but you've got to let them win. You can't interrupt the trade with your fears and irrational concerns.